So now let's talk about what to report to the IRS year after year. If you own the property personally, even if you have an LLC, you'll report the income within your 1040 on Schedule E. If you own the property with another partner in an LLC, that means that you'll file a Form 1065 partnership tax return. Included in that will be K-1s for each of the partners that will show your share of the profits. You'll use that K-1 to claim your income on your 1040. But the taxation is the same whether you're a single member LLC or a multi-member LLC, a partnership. You have to pay tax on your rental income that you earn year after year. No questions asked. But in order to reduce that rental income that you pay tax on, you're allowed to deduct expenses that are directly related to the property operating, kind of like a business. You can deduct repairs, utilities, real estate taxes, mortgage interest that you pay, not the principal payments, advertising, landscaping, HOA fees. These type of expenses can be deducted in the year that the money is paid out. But you can also use the depreciation of the property to reduce your taxable income. The house isn't going to last forever, and the IRS understands that. So they allow you to depreciate the house over 27.5 years and recognize an expense yearly. As an example, let's say that we determine the house is worth $250,000. Dividing that by 27.5, that's a $9,090 expense yearly with no cash out of pocket. But there are two important things to know about depreciation. It's a function of timing, so when you sell the property, you have to factor all that depreciation that you took into the cost basis, which reduces the cost basis and increases the gain on the property sale. And you can't depreciate land that the building is sitting on. You can only depreciate the building itself. So an allocation has to be made to value the building separately from the land. Depreciation allows many investors to have a positive cash flow every year, but one that doesn't create any additional taxes for the investor because the depreciation can reduce a sizable profit to a loss. And that is what everyone wants, right? Something that generates income or positive cash flow, but with no taxes due as you're earning it. Another caveat about real estate depreciation is that depreciation also affects investors when large improvements or repairs are made to the property. Think of big improvements like roof replacement, AC replacement, new flooring, a full gut and remodel. Think large property improvements that will increase the home's value. Now, these type of expenses cannot be expensed immediately in the year that the expense is incurred. At least I wouldn't advise doing so. These improvements should be depreciated over 15 years, unless you know that there is a shorter lifespan for the asset, which you should adjust accordingly. Remember when tax planning that these large expenses will not necessarily translate into immediate write-offs in that year against your business income. Nor should you want them all to be expenses right away anyway, because of the rules and limitations of deducting real estate losses. If you're paying a management company to handle the rental for you, you won't be able to take a loss if you have a tax loss. Instead, you'll be stuck with a passive loss carryover that you'll carry with you every year until you eventually generate passive income to offset it. But if you're actively answering the tenant's calls and managing the property, you can take a loss up to a certain amount, depending on your income, unless you're a real estate professional. Being a real estate professional means that you work more than 750 hours per year in the real estate trades or businesses. And if you qualify as a real estate professional, it unlocks the ability to claim an unlimited amount of tax losses in a given year on your real estate income. A rental property can often be an incredibly beneficial asset to have in your portfolio. But remember, all the depreciation gets factored in when you sell the rental property. So be mindful of that and prepare for the tax bill when you sell the property.